If you've been monitoring the distributed ledger technology space, you know that for a long time, the Holy Grail has been solving that impossible trinity, achieving speed, security, and true decentralization all at once. For years, the answer was just, optimizing existing blockchains. But today, we are diving deep into a project that just skipped that framework entirely. We're talking about Hedera Hashgraph and its native token, HBAR.
Right.
Our mission today is to unpack the core technology, the hash graph, that makes this network so revolutionary, and maybe more importantly, explore the specific, often surprising, real-world utility that's thriving in its ecosystem.
And the governance, you have to talk about the governance.
Exactly. We need to look closely at that, because this innovative structure has attracted massive corporate names. We're talking Google Cloud, IBM, Boeing, LG.
Okay, so let's unpack this unique alternative to traditional DLT.
It's absolutely necessary to start right at the foundation. Because Hedera isn't just an iteration on a fast blockchain. It is structurally completely distinct.
Right. When you look under the hood, Hedera is a distributed ledger, yes, but critically, it is not a chain of blocks. It uses the Hashgraph consensus algorithm, and that just changes everything about how data is ordered and finalized.
So how does the Hashgraph achieve consensus without the blocks and miners we traditionally visualize when we talk about crypto?
It relies on two pretty ingenious components. The first is called a gossip protocol.
Gossip protocol.
Yeah, where nodes share transactions and their entire history with other randomly selected peers, and they do it incredibly quickly. This rapid sharing, it just builds this comprehensive picture of the network state almost instantly.
And the second component?
Second is a virtual voting algorithm. So essentially, the nodes don't wait for formal votes. They just look at the shared history, the gossiped events, and determine with mathematical certainty what the outcome of the vote would have been.
So instead of a linear chain?
Exactly. Instead of that, Hashgraph creates something called a directed acyclic graph, or a DAG. Think of a blockchain as a straight, single-lane road where all the cars have to wait in sequence.
Right, one after another.
The DAG is more like a continuously weaving fabric or a web of data. It allows transactions to be added asynchronously and in parallel, which is where that phenomenal speed comes from.
And that structural difference, that translates directly into some pretty hard-to-match metrics. What stands out most when you compare Hedera to established layer ones?
Well, the security and the speed. For security, Hedera achieves a synchronous Byzantine fault-tolerant consensus, ABFT.
Okay, that's a lot of technical jargon. What does that mean in practice?
It just means it's the highest level of security possible. The network is mathematically guaranteed to be safe and accurate, even if up to 1/3 of the nodes are compromised and are actively trying to lie to the network. And that guarantee is absolutely vital for institutional adoption.
And on speed, what are we talking about in terms of finality?
We're talking about transaction finality. The point where it's settled, it's immutable on ledger within 3 to 5 seconds.
On average.
3 to 5 seconds. And the current throughput is throttled at 10,000 transactions per second in a single shard. So you've got high volume combined with near instant finality.
I know the cost is also a massive draw for businesses, the fact that it's fixed and predictable.
Absolutely. Fees are fixed in US dollars, but you pay them in HBAR. Most transactions are under a penny, which makes these complex enterprise applications actually feasible. And speaking of feasibility, let's talk energy. Hedera has the lowest energy consumption per transaction of any public DLT.
How low are we talking?
It clocks in at just 0.03 watt-hours per transaction.
Wow.
To give you some perspective, a single email is often estimated to use around, 0.01 watt-hours? So Hedera is operating at a scale that makes it more energy efficient than a lot of our daily digital activities.
Which is why it's certified carbon negative.
That's right.
That focus on predictability and security seems tailor-made for institutional use, especially when you think about the problems networks like Ethereum face with transaction ordering. You mentioned fair ordering. This is a huge feature. What is it, and why does it solve what some call a catastrophic risk?
Fair ordering directly addresses the issue of maximal extractable value, MEV attacks.
MEV.
Right. These are complex manipulations where actors, often bots or miners, can spot a pending transaction in the public queue, the mempool, and front-run it. They reorder transactions or censor them to extract profit for themselves.
So what does a typical MEV attack look like for a user?
Okay, imagine you're trying to swap, say, $100,000 worth of tokens on a decentralized exchange. A malicious actor sees your pending transaction. They issue their own transaction just nanoseconds before yours to drive the price up, and then they sell immediately afterward.
So they're siphoning money directly from your trade.
Directly for you through arbitrage. For large, compliance-conscious institutions trading millions, this isn't just annoying, it's systemic market manipulation.
And Hedera avoids this completely.
Yes, because Hedera transactions are ordered chronologically based on the median timestamp generated by all the nodes together,
Right.
not by who paid the highest fee or by the choice of a single block producer. It just completely eliminates the ability to bribe or front-run trades. It ensures the integrity and the fairness of that transaction history.
Okay, let's talk about the structure that supports this institutional focus. Governance. The Council of Major Corporations. Google, IBM, Deutsche Telekom. This is the elephant in the room for so many DLT enthusiasts. You hear, wait, established corporate giants governing the network? Isn't that the exact opposite of decentralized, trustless DLT? Why would a listener accept that trade-off?
That is the most crucial question. And Hedera's model of decentralization is different because it prioritizes a specific kind of trust, institutional and regulatory trust. Traditional crypto decentralization often aims for anonymity. Hedera's model, the governing council, aims for accountability and distribution. The council members are geographically distributed, they cover diverse, non-competing industries, and they are known entities with huge reputations to protect. They are legally required to run mainnet nodes.
So for a bank or a stock exchange, that's more reassuring.
Far more. For compliance-conscious institutions, this setup provides stability and minimizes risk. They trust the collective accountability of known, established global players far more than a totally anonymous cohort of validators.
So Hedera is effectively carving out a specific niche then, a public DLT that is regulatory friendly by design. It's embracing a structure that eliminates the counterparty risk that institutions are terrified of. It's a deliberate pivot away from, let's say, maximal ideological decentralization toward maximal institutional suitability.
Exactly. They're building a robust, leaderless network that eliminates front-running risks while ensuring there's institutional accountability guiding the future of the platform.
So we have the foundational tech, the DAG, the ABFT security, fair ordering, all supported by this institutional governance. Now let's move to the tool set. What are the key services that developers actually use to build these real-world applications?
Hedera offers three primary network services. The first is the consensus service. This is essentially an immutable audit trail. It provides verifiable timestamps and ordering of events for any application.
So you could use it for tracking supply chain assets or...
Exactly. Or ensuring the timestamp on a legal document is provably accurate, or managing IP rights for music streams. Second is the token service, or HTS. This is huge because it lets developers configure, mint, and manage native fungible and non-fungible tokens easily, all without complex smart contract coding.
So it's like using a simple API. Is it fair to say it's sort of like Stripe for digital assets, making the complexity just disappear?
That's a great analogy. It handles all the heavy lifting, allowing institutions to issue millions of regulated assets quickly and cheaply. And finally, they have robust smart contracts. This enables the on-chain programmability. And because Hedera supports the EVM.
The Ethereum virtual machine.
Right. So developers can port their Solidity-based contracts, the standard language, very quickly, but they get to run them with all of Hedera's high throughput and fair ordering benefits.
Which means Hedera isn't just competing in the enterprise space, it's enabling diverse fields. Supply chain, digital identity, DeFi, and, crucially, it's being used by organizations exploring the architecture for central bank digital currencies, CBDCs. Okay, now for the proof in the pudding. This reliability and speed must drive a vibrant ecosystem. Let's look at the projects leveraging this infrastructure right now. This is where it gets really interesting, I think.
Let's start with Hashport, because interoperability is so key. This is a decentralized two-way bridge connecting Hedera directly to EVM-based networks like Ethereum and Polygon. This isn't just a convenience, it's a necessary artery.
And why is that bridging capacity so critical for Hedera's institutional goal?
Because enterprise customers don't live in a silo, right? They need to access liquidity and assets on the major chains. Hashport enables that secure transfer of assets, especially ERC20 tokens. It allows external capital to flow into the Hedera DeFi space, typically for a pretty manageable 0.5% service fee.
Speaking of DeFi, Hedera has a couple of major DSEXs thriving.
It does. SaucerSwap was the first, launching in mid-2022. It uses the standard automated market maker protocol, but because it's on Hedera, its users benefit immensely from that fair ordering. Swaps cost about a penny, and you are protected from the MEV attacks that plague large Ethereum-based DEXs like Uniswap.
That protection alone is a huge selling point for active traders.
Absolutely. Then you have HeliSwap, which is adapted from the popular Uniswap v2 protocol. Same benefits. Sub-penny costs, 3 to 5 second finality. Its native token, HELI, is used for governance of that specific DX.
And we should mention Stater Labs too.
Yes, which specializes in non-custodial liquid staking. They offer HBRX, which is key for providing liquidity within that DeFi space.
Beyond finance, what about the creator economy and digital collectibles? These are often the first sectors to really test a network's speed.
That leads us to the success of Zeus Market. This has quickly become the leading NFT platform on Hedera, supporting over 80 verified collections. They've processed a massive volume, over 170 million HBR in transactions, which shows there is real retail interest and engagement with digital assets on Hedera.
And project number 5, Galaxy, is a fantastic anecdote that connects the technology to a real-world personality.
It is. Galaxy is a social marketplace for content creators and their fans, and it was co-founded by NBA player Spencer Dinwiddie. What Galaxy does is leverage Hedera's capabilities, that 10,000 plus TPS and the token service, to let creators mint and trade exclusive NFTs for fan engagement, instantly and affordably.
Which you just can't do on legacy chains.
Not without high fees and long waits. Galaxy lets creators bypass all that friction, making digital fan interaction seamless and cost-effective.
And finally, a project focused purely on utility infrastructure, naming.
That's hashgraph.name. This service is Hedera's version of the Ethereum name service, or ENS. It connects human-readable names like bear.hbar to those long, machine-readable Hedera addresses.
A simple utility, but it makes the whole user experience so much better.
It vastly improves the accessibility of the entire ecosystem.
That is a deep and compelling lineup of use cases, from complex bridges to NFT platforms. Now, let's pivot to the token itself, HBAR, and the process of staking, which secures the network via proof of stake.
So HBR is essential. It's the network fuel and the security mechanism. Staking is delegation-based. You delegate your HBR to a node run by a governing council member.
What's the appeal of staking HBR compared to other networks that might penalize you or lock up your tokens?
The appeal is complete control. Crucially, there is no minimum staking period, and there are absolutely no penalties or slashing mechanisms for unstaking your tokens. You retain full custody of your assets throughout the whole process.
And rewards are just based on the node's performance.
Yes, but it's important to note that a node requires a really substantial stake, a threshold of 250 million HBAR, to begin generating those rewards.
That 250 million HBAR minimum stake seems deliberately high, which again reinforces that institutional preference we discussed earlier. It solidifies that the network operators are well-capitalized, major entities.
Precisely. It filters the core responsibility to large, committed, and accountable entities.
So let's discuss the practical side for listeners. I know the staking yields rebalanced significantly in 2023. What are the current reported APY rates?
Yes, the rates were adjusted as the network matured, moving away from previous highs. So if you were using a self-custody wallet like Hashpack or a Ledger hardware wallet via Hashpack, you're looking at an APY around 2.5%.
And on a centralized exchange.
If you choose a CEX like Coinbase for convenience, the yield is far, far lower, sometimes reported as low as 0.06% APY. However, the most competitive rates are often found in liquid staking. Stater Labs, through its HBRX token, currently reports up to 5.61% APY.
And that's popular because your assets aren't locked away.
Exactly. It allows you to earn rewards while keeping your assets liquid to use in other DeFi protocols, adding another layer of utility.
And for security, you always advise self-custody over the convenience of a CEX.
Always. For maximum security and control, self-custody wallets like Hashpack or hardware wallets are the gold standard.
Yeah.
While centralized exchanges are easier for beginners, you have to remember that the exchange becomes the custodian. They control your tokens, which adds counterparty risk.
The very risk Hedera is designed to eliminate.
Precisely.
This has been a truly comprehensive deep dive into a fascinating technology. So if we summarize the key differentiator, Hedera is a layer 1 network offering high-performance 10,000 TPS, sub-penny costs, ABFT security, all achieved with carbon-negative sustainability.
That's the snapshot.
Yeah.
And if we contrast it with other high-performance networks, Hedera is not a layer 2 scaling solution like Polygon, which is built on top of Ethereum security.
Right.
Nor is it simply a fast proof-of-stake network like Solana, which uses a different mechanism entirely, proof of history, and still deals with issues like front-running.
Instead, Hedera provides that layer 1 simplicity, governed by established enterprises, and it's designed specifically for stability and compliance. So, what does this combination of features mean for the future of the enterprise DLT space?
Well, if we connect this to the bigger picture, Hedera's unique combination of institutional governance, mathematical security, and fair ordering creates a bespoke solution for global enterprises and financial institutions. They are designing a public distributed ledger that adheres to the strictest risk and compliance requirements in the world.
Which fundamentally challenges the dominance of existing DLT standards.
Precisely. The source material emphasizes that Hedera's goal is to offer a public distributed ledger designed for these compliance-conscious institutions. So, considering the network's emphasis on legal adherence and removing systemic market manipulation like front-running, how might the successful adoption of Hedera's unique model ultimately pressure existing, slower, or less regulated blockchain standards to dramatically adapt?
Or risk being entirely sidelined in the crucial, high-value enterprise sector?
It's a question of whether technological superiority, built for compliance, can ultimately supersede the network effects of legacy crypto infrastructure. Something for you to mull over as you watch this space evolve.